Tax benefits of selling your primary home. Selling your primary home can come with significant tax benefits, particularly if you qualify for the capital gains tax exclusion. Here's an overview of the rules, how the exclusion works, and additional tips for tax planning. Capital gains tax exclusion. The IRS allows you to exclude up to $250,000 of capital gains for single filers, $500,000 of capital gains for married couples filing jointly. This exclusion applies to the profit made from selling your home. No tax on sale proceeds. Only the gain, profit, from the sale is taxed if it exceeds the exclusion limits. The amount you receive at closing is not taxed directly. Exemption from net investment income tax. If the capital gain is fully excluded, it won't be subject to the 3.8% net investment income tax, even if your income is high. To qualify for the exclusion, you must meet the following criteria. Ownership test. You must have owned the home for at least 2 years, 24 months, during the last 5 years before the sale. Use test. You must have lived in the home as your primary residence for at least 2 years during the last 5 years. Frequency test. You can only use the exclusion once every 2 years. Special circumstances. Exceptions may apply for health issues, job relocations, or unforeseen circumstances if you don't meet the full ownership and use requirements. Determine your gain. Subtract your cost basis from your selling price. Cost basis =, purchase price plus improvements, plus certain fees, for example, closing costs, real estate commissions. Tax benefits of selling your primary home. Purchase price, $300,000. Major improvements, $50,000 cost basis, $350,000. Selling price, $600,000. Capital gain, $600,000. $350,000 $250,000. If you're a single filer, this gain falls within the exclusion limit, so no tax is owed. What if you exceed the limit? Any profit above $250,000, single, or $500,000, married, is taxed at the capital gains rate. 0%, 15%, or 20%, depending on your income level. Reporting the sale. If your capital gains are fully excluded, you generally don't need to report the sale to the IRS. If not, use Form 8949 and Schedule D to report the gain. Improvements versus repairs. Only capital improvements, for example, adding a room, new roof, increase your cost basis. Regular repairs, for example, painting, fixing leaks, do not. Special cases, divorce. If you split ownership of the home, the exclusion applies to each spouse's share if they meet the rules. Military personnel may suspend the 5-year use rule if on qualified duty. Partial exclusion. If you sell the home due to unforeseen circumstances, for example, health, job change, you may qualify for a reduced exclusion based on the time you lived there. Tax benefits of selling your primary home. Lived in the home for 1 year instead of 2. Exclusion amount $250,000 x 12 months, 24 months, $125,000. Capital gains tax rates. If you can't exclude the gain, the amount is taxed at your capital gains rate, 0%, 15%, or 20%. Some states also tax capital gains, but may offer similar exclusions. Check your state's tax rules for home sales. Track all improvements. Keep records of renovations and upgrades to increase your cost basis. Time the sale. If your gain exceeds the exclusion limit, consider selling in a year when your income is lower to potentially qualify for a lower capital gains tax rate. Convert rental to primary residence. If the home was a rental property, living in it for 2 years can allow partial exclusion of gains. Defer taxes with a 1031 exchange. If the property was used for business or investment, you may defer gains by reinvesting in another property. Would you like help estimating your tax liability from a home sale, or learning about other strategies to minimize taxes? For personalized guidance, please reach out. The award-winning Realtor, Syed Firoz, at 470-269-0420 or email sfirozrealestate@gmail.com.